Hi everyone, thanks for stopping by and seeing what I'm up to. Meet Kevin has some updates. Feds just spoke, and he's a-talking. So let's hear.
For their July meeting was just released, so we get into the minds of what the Federal Reserve Board Committee is thinking about the state of our market, what's going on with inflation, businesses, credit, and more. Let's get right into it. I'm going to pull it all up. I read every word in this report, and folks, it just came out, so let's go through it together. By the way, remember to get 2 free stocks with Webull. You just deposit $100, and they give you 2 free stocks. You take all that money if you want, if you don't want to stay there. And remember to get life insurance in as little as 5 minutes. Lauren and I have it.
Hold on. Now, I don't know my insurance company offhand. He is being sponsored by those 2 places, Webull and the life insurance. My life insurance literally cost me $8.98 a month. I will look up that information and make sure that I'll do a video on it. That's all there is to it. The Webull. It's 100% random. You deposit $100 and you could get 2 free stocks from $3 worth to $1,500 worth. It's a gamble. So, in a time of a pandemic when we really don't have money to be investing, Schwab's is also doing what they call slice stocks. Check that out, as low as $5 a stock. I am on my Cash App, which I'll make a video on it, and you can buy slices of Walmart, Coca-Cola, GE, but I'll go on to do that later in a video. I just want to let you guys know that those free stocks could be very low. I mean, free is free, but come on, really? They're going to hand out $1,500 worth of stocks and chance you selling and taking $1,500? I doubt it. So, if it's too good to be true, it is.
You can Apple pay for it, Android pay for it. Both of those links are down below next to the awesome links for the programs. Let's get into the content. So when I do these reviews, I like to go right into the text and show you exactly what I highlighted. That doesn't mean I got everything, but I do my best, so here we go. Obviously, they mentioned many times that the virus is going to have a big impact on the future of the economy, and obviously we have weaker fundamentals in those recovery stocks. So still be careful if you're speculating on the recovery stocks. Personally, I think almost the best thing to do is consider swing trading the speculative recovery stocks. I don't know how much we can buy and hold them right now. Those are going to be like your retail, your hospitality, your airlines, and so on. The Federal Reserve says that they no longer have any outstanding balances from their repurchase agreements. In English, what this means is that the monetary system is actually functioning again. We had massive problems with this back in last September when the Federal Reserve had to swoop in because interest rates shot up to like 10%. We want stability here. We don't want the Federal Reserve to have outstanding balances here, and they don't now. So this is good. This is a return to normal. It's a little bit more stability. Obviously, the actual economy isn't normal, but in terms of money systems, this is a good sign. Federal Reserve's balance sheet declined slightly because of that. All right, let's go on to the next page here. Now let's talk a little bit about inflation. Obviously, inflation is substantially down. We're seeing disinflation, which is just sort of less inflation than we normally see. We're not seeing deflation. Some of this is because of, well, obviously, there's not a lot of spending happening in certain sectors of our economy, and oil prices are way lower because, well, there's less demand for travel right now, which tends to push oil prices down. So definitely, low inflation, but no major concerns of deflation right now. We'll actually see another note on that in just a moment. In fact, the University of Michigan's survey of consumers believes that over the next 5 to 10 years, the expectations for inflation are actually going to remain low. The Federal Reserve, though, likes to use a 3-year measure, and they see inflation staying relatively low over the next 3 years as well. Furthermore, they indicated that real disposable income declined after the stimulus sort of wore off. So we saw real disposable income, money people can spend, go up in April with the stimulus, and then down in May. This is expected, and we did see wage and salary income go back up strongly in May. This is a very good thing. Now, they're starting with the good. There's definitely some problems coming up here. One of the issues that they continue to refer to is that business investments have not begun to recover. So most businesses are still too uncertain to actually start thinking about expanding their businesses. Later in this PDF, they suggest that if we had more stimulus, maybe businesses would actually consider expanding and hiring.
Yeah,
so for
maybe.
a lot of businesses are just trying to get through this. They also mentioned that nominal business spending on non-residential structures outside of drilling and mining declined further in May. So basically, outside of the housing market, which is booming, and outside of mining and drilling, everything else is declining. Probably like commercial business activities and so on and so forth for spending on structures and commercial real estate and that. Not a surprise. Industrial production picked up, and it was actually led by motor vehicles and related parts following extended automaker shutdowns from mid-March to April. So basically, because car dealerships opened up again after the mid-March and early April shutdowns, they started seeing some declines in car sales. The French company, and I can never get their name right, I think it's Peugeot. Anyway, they are actually testing a direct-to-consumer model just like Tesla is, which is really interesting. And Tesla's not really testing it. I guess Tesla is just doing it. You go on their website, you buy a car, you get the car kind of thing. And they're now trying that in Europe as well. So we'll see if that becomes more of the norm to replace the dealership model. But either way, car sales and car production are up because of that. State and local government purchases have declined substantially. This is not a surprise. Payrolls at the governments also shrank. Also not a surprise because these state and local governments are totally running out of money. And that's why there's such a debate in Congress right now, trying to get more funding for them. Nominal U.S. international trade deficit widened. Basically, here, highlighted, exports decreased more than imports decreased. So everything went down, but we produced less than we brought in other words. And that's kind of been the trend lately anyway. All right, regarding sentiment, the boost to sentiment appeared to have been offset by concerns about the domestic spread of the coronavirus and its uncertain effects on the future course of the economy. Okay, in other words, the Federal Reserve is finding that people got really excited in early June, early July that, hey, the pandemic's ending. But then as we started seeing cases tick upwards again, well, people got sad again. Not a surprise. Right now we are getting kind of a general downtrend in cases. This is being recorded on August 19th here. Obviously, this Fed paper is a little bit lagging. It tells us what they were thinking at the end of last month. But it's still very insightful to see exactly what they're paying attention to. This was really interesting, and this is the kind of stuff I read the report for. The rebound was reportedly driven primarily by investors' interpretation of recent economic data. Here you go, which suggested that the risk of deflation had abated. Now we're going to talk about negative rates too. Take a look at this. Somewhat. Abated somewhat. As well as by the improvement in market liquidity. In other words, there was fear that rather than just worrying about inflation being low, we might actually go into a deflationary market, which is really bad because then you start seeing deflationary spirals. It becomes hard to get out of debt. And overall, when prices fall, people delay spending, and that just reiterates a tougher market or a tougher recovery. So in other words, we don't want to see deflation. Some inflation is actually good. It looks like the measures that they're looking at, such as market implied forward rates, referring to 2021 and 2022, remained slightly negative. In other words, the market is expecting very low inflation through 2021 and 2022. This aligns with what the Federal Reserve believes. The Federal Reserve also said that it looks like people, based on their commentary in the markets, know that the Federal Reserve does not plan to have negative interest rates. There was a period of time we were talking a lot about, oh my gosh, is the Fed going to have negative interest rates? And the Fed is saying they're not planning on doing negative rates, and the market doesn't actually seriously think the Fed is going to have negative interest rates. So again, this is just a reiteration that the Federal Reserve says, hey, look, no chance we're going to see negative rates. And the market seems to understand that, even though the future targets can look negative, right now it seems like everybody just realizes we're going to have very low inflation for the next couple of years. So no huge inflationary pressures that people are looking for or looking at right now. The volatility index has been up and down, and it's also expected to go up again. And it already is going up again before the election. Obviously, we expect to see a lot of volatility before the election. Overall, lots of markets that the Federal Reserve has up and running are stable. On credit, the credit quality of non-banks, basically any company that's not a bank, deteriorated further over the intermediate period. Basically, it sounds like businesses are getting slapped pretty hard here in June and July, with a sizable volume of speculative grade debt downgraded in June. Some more junk bonds. They also say that June defaults were high as well, and market indicators of future default expectations also deteriorated somewhat. Now, deteriorated usually would mean that default expectations got worse. That is, they do think there might be more defaults coming up, aka we might see some more bankruptcies. I don't know why they have to write it so complicated. But anyway, municipal market financing commission, blah blah blah, remained accommodated. Okay, cities and towns around the country are starting to have their credit quality go down too because they've running out of money. Financing conditions for small businesses remained tight. Yeah, this is not a surprise. I mean, short of the PPP and maybe the small business loans that exist, it's really difficult for small businesses to get loans right now. And part of that is because small business loan performance deteriorated significantly, with short-term delinquencies comparable to levels seen in early '08. That's right before the recession, the '09 recession. Wow, and the crash at the end of '08. So not a good sign in the business sector so far. A lot of concerns in business, specific concerns obviously in small business. Financing for commercial real estate recovered. Real estate overall seems to be strong. The Federal Reserve is also buying a lot of mortgage-backed securities, both commercial and regular residential mortgage-backed securities. That helps keep money flowing. However, they do find that credit continues to flow to borrowers with higher credit scores. If you haven't gotten your credit score up yet, pick up the Apple Card or something, folks. We got it right here. Get the Apple Card. Get yourself some kind of credit card. It doesn't matter what it is. Just pay it off every month. Don't use this as a license to spend. Don't get it if you're not going to pay it off every month. It's kind of like having margin on stocks. It's almost like sometimes you just need to disable margin so you're not tempted to use it. I get it. Like, I have that problem too. That's why I put my money at M1 Finance, and I wish they sponsored me to say that. All right. The staff assumed that additional stimulus. Oh, look at this. Although the staff assumed that additional fiscal stimulus measures would be enacted beyond those anticipated in June, aka the people at the Fed were like, oh yeah, we're going to have more stimulus in August. Oops. Nope. Despite that, they did say that substantial stimulus from the CARES Act and the eventual anticipation of new stimulus did help bolster the economic recovery. It's so weird that just the anticipation of more stimulus could help. Except right now it feels like we're getting the rug pulled out from under us because Congress sucks. Inflation forecast to pick back up over 2021 and 2022. Yeah, and this is their expectation overall. This aligns with what they said earlier. That sounds a little confusing, though, because earlier they said they think that inflation is going to stay low between 2021 and 2022. But what they're saying is they're expecting to start seeing inflation slowly pick up over the 2021-2022 period. And remember, they expect to keep interest rates low until 2023, which really means they'll probably expect to see inflation in 2023, which aligns with what they're saying here. The staff judged that a more pessimistic projection was no less plausible than the baseline forecast. In other words, it's quite possible that we could see another round of shutdowns and limits on social interactions later this year, decreasing GDP and jumping the unemployment rate. They believe that this scenario is just as likely as us actually getting a vaccine and getting out of this pandemic. So they're like flipping the coin. They're like, pandemic or no pandemic? All right, what else do we have here? Then we've got participants observed that with this rebound, household spending likely had recovered about half of its previous decline. Consumers purchased goods, including motor vehicles, other durables, that'd be like a washing machine or refrigerator, right? Especially goods sold online. This is big. The online play is so huge right now, and that's why Amazon's got huge. What else we have? With regard to the behavior of household spending, participants pointed to information from district contacts and high-frequency indicators, such as credit card and debit card transactions and cell phone location tracking, suggesting that increases in consumer expenditures had likely slowed. Not good. So basically, it's kind of like, imagine this. Yay, everybody's spending again, Why are they not spending as much anymore? We really wanted that to continue, but it's not. This is kind of where we are, and that's partially because of these cases having gone up at the end of July there. We'll see how school reopenings obviously treat us. Furthermore, in terms of sentiment, they see a rebound in consumer spending, but less improvement in the business sector. This is what we heard earlier. Basically, high levels of uncertainty and risks, challenges with supply chains, employee absenteeism in some cases. Small businesses were under significant strain. Fiscal support was uncertain. Still low oil demand, excess inventories, low oil prices. The pace of declines in initial unemployment insurance claims had slowed in recent weeks. In other words, we're not falling with the unemployment rate as fast as we would like. Things are kind of slowing in the pace. Prospects for further improvement in the labor market would depend on broad and sustained reopening of businesses. However, obviously we know that the pandemic has complete control over that. And they reiterate here that African American and Hispanic women especially are bearing a disproportionate share of the economic hardship caused by the pandemic. All right, what else do we have here? In their comments about inflation, participants generally judged that the negative effect of the pandemic was more than offsetting pressures from supply chain constraints. There we go. AKA, even though there are issues at businesses' supply chains, especially in food and grocery stores, there's so much less spending happening right now that the odds of us seeing inflation anytime soon are very, very low, and they expect inflation to remain well below their 2% objective. And they talk about how accommodative they are, how things are, related to how the virus recovers, and we might see more bankruptcies. It's kind of like a warning to Congress. And then they always got to slam Congress. Fiscal policy support would be necessary to encourage expeditious improvements in labor market conditions. AKA, you want to see the unemployment rate go down? Then give us some of that stimulus money. All right, especially for businesses. Rates obviously stayed at their 0% target, but we already knew that from when this meeting was held. This is kind of just a quick little summary they throw in here, low inflation pressures, yada, yada, yada. And there you go. Check out the...
I will make sure that his links to his insurance and Webull are down below. I'm going to have to start doing my own news channel. Like, subscribe, and share, guys, because I've got a lot of stuff to say. Bye-bye.